Take a look at oil prices this morning, down about 12 cents a barrel, 47.71, under pressure on oversupply concerns. The American Petroleum Institute reporting that gasoline inventories rose sharply last week. Joining us now is the Schork Report publisher, Stephen Schork. Stephen, we're waiting for oil inventory numbers today from the Energy Information Administration. And the top story today in the Wall Street Journal is that Chevron is looking for a new CEO, and this is really emblematic of a new era in oil. Does that mean lower prices in this new era?
Well, it's certainly, when we look at who Chevron looks to tap to run after Mr. Watson moves on, it's an individual with extreme experience in the refining sector. And what we've seen this year, Dagging, is very wide margins. It's very good to be an oil refiner nowadays in this low crude oil price environment. So when you have a commodity, your chief feedstock that goes into your unit, and it's at historical lows, and hence it looks to stay very low for a very long amount of time, and you have the end product, which is attracting 20, 25, 30% margins at this point. Clearly, this is the business you want to be expanding, and certainly the move at Chevron, similar to what we've seen at Exxon and Total, seem to indicate that the industry is pushing not only towards natural gas, but also towards the crude oil refining sector of the market.
Hey, Stephen, it's Mike Murphy. Just watching
Mike.
Oil rallied from down around $40 up to where it is now, $47, $48 range. It seems like a lot of the U.S. equities, the energy stocks, haven't rallied as much. I was wondering if you could speak to that on why a lot of the energy stocks here in the U.S. are at or near lows, yet oil's had a 20% rally recently.
It's had a 20% rally, Mike, but we also have to kind of examine why did that market rally. So we came into this summer, we have record demand for crude oil. Demand for crude oil has never been stronger, and yet crude oil still cannot make a good break above $50 a barrel. So at this point, what you had at the beginning of the summer is everyone was leaning on one side of the ship. Everyone was bearish. So of course, now through the summer, through this record demand, we had a nice contrarian pop in prices. Now the concern as far as equities go and prices going forward towards the end of the year is seasonality. The Labor Day holiday is 2 weekends away. That means that the holiday driving season is over. After that, we're going to go into the fall maintenance season, the turnaround season, where refineries are going to be buying fewer barrels, anywhere between 700,000 barrels less to 1.2 million barrels. So with that, a significant amount of demand coming out of the market, and let's keep in mind, production is high. It's at a 2-year high. The market is well hedged. Production is going to keep on coming to the market while demand starts to fall through the fall. So that is indeed weighing on prices and likely weighing on the shares of oil-centric equities.
Stephen, we had Tom Closa, who works at the Oil Price Information Service, on last week, and Tom said that we will never see $100 a barrel oil again in my lifetime. Do you agree with that, given the new technology, given all of the new oil companies that are producing and the excess production that we're getting here in the United States?
Oh, absolutely. I'll even take it down. I don't think we'll ever see $70, $80 oil anytime, certainly not in the near future, because we're at that DY over DX moment where demand is going to be stagnant, but supply, because this new technology and the new productivity is going to continue to bring more oil to the market. So indeed, when we look at the impact of EVs, hybrids, so forth, the demand destruction, it's certainly not your grandfather's oil market at this point. So yes, absolutely. This goes back to OPEC. 2.5 years ago, when everyone thought OPEC was trying to destroy North American production, they weren't, because they couldn't. So at this point, what OPEC did 2.5 years ago, they did the North American industry the biggest favor, because they taught the industry how to become lean, how to squeeze out greater productivity, greater margins, how to make money in a low cost and a low oil price environment. So low oil prices in between that $45 to $55 range, very hard to see it as making any sort of significant breakout to the upside, because now for the first time ever, we have substitutes into the market. You have EVs, you have the hybrids, so forth. So this is something that the market's never had. The genie's out of the bottle. So no, $100 a barrel, I agree with Tom, and I'll take it down. I don't think I'll ever see $80 oil at any time in my future.
Stephen, thank you so much. And again, when you try and put the squeeze on Americans, we sit back, we collect ourselves, and then we say, we'll show you what we got. And doggone if those oil companies didn't do that to OPEC. Thank you, Stephen.
Absolutely.
Stephen Schork.
Thank you, Dagan.